When you're looking at life insurers, the key thing to focus on is the cash generation. That's the cash coming out of our life operating companies up to the holding company. And last year our cash generation was £2 billion. That was up 35%, and that was a record level. Second thing to focus in on is the strength of the balance sheet, and our balance sheet remains very strong with a solvency capital coverage ratio of 176%. But what I was particularly pleased about in our results last year was the new business growth from our standard life business. So our new business net fund flows were up 72% in a market that was broadly flat. And our new business long-term cash, the future cash from new business, was up 23% to £1.5 billion. And that hit our targets 2 years early. And that's given the board the confidence to move to a progressive and sustainable ordinary dividend policy with an intention to grow the dividend every year.
I see that. 2.5% increase in final divvy to 26.65p per share. Tell me a little bit about the cash generation. You just said 2 billion, didn't you, this year?
Yes.
Your target's 1.4 billion in 2026. Was this just a special year then or something?
Yeah, so at Phoenix we're pivoting from being just a closed book consolidator to building out the standard life business and building organic growth. And so what we've also done today is to said to the market that of the 2 billion of cash, 1.1 billion is the sustainable operating cash generation, what you can rely on year by year without the one-offs you get with doing M&A. And we're saying that the 1.1 billion of the 2 billion that's operating cash generation, that will grow to 1.4 billion over the next 3 years.
It's almost one of those, look at you, you're going all grown up. Because your company, how I knew Phoenix and have known Phoenix over the years is this voracious hoovering up of closed funds. And off camera, Andy was saying that actually, and you're pointing out that actually it's a different business model following the standard life, and is that the hub from which you're going to grow everything from?
Yeah, so when I joined Phoenix 4 years ago in 2020, the only way we could grow was through M&A, and I got a clear mandate from the board to build out our organic growth capability through the standard life business, which is what we've now done. So we're now growing strongly organically. M&A still remains something that we're interested to do, but we're no longer solely reliant on it. And the bar is higher in terms of thinking about M&A because we're getting really attractive returns from the investments we're making into our organic growth through the standard life business.
What are assets looking like at the moment if you were to embark upon M&A? What do you make of the pricing at this stage?
What I'd say is overall there are a finite number of books available in the UK market, and from our perspective, as I say, the bar has gone higher because we're deploying capital at really attractive returns in terms of organic growth. So it's still something we'd actively consider, but the bar is higher in terms of what we need to achieve to make it attractive relative to the organic growth opportunities. And one of the things we've set out today is a clear capital allocation framework and how we plan to allocate our capital and excess cash over the next 3 years with the returns we expect to get across those different areas. And that's driving the growth in the operating cash generation from the 1.1 billion to 1.4 billion over the next 3 years.